Hello, everybody, and welcome to the Worth Unlimited Worth Account Presentation. This would be the Orientation 100, and this is our ALOC presentation for September 11th, 2017. I want to start off by telling you a little bit of our story. We started in the mortgage industry back in 1997, and we were one of the Utah's fastest growing companies in a 3-year period. We realized the significance of a problem with debt and launched our first version of the program in 2004. We did a beta test of which I ran that beta test, and I was the individual that sold the first 400 homeowners. And what we found out that was a year later on that product, our average client was about 20% ahead of the numbers we had originally projected in the analysis that we give. Currently, we have over 70,000 clients using the step reduction system to become debt-free. We were recognized and awarded back in 2008 with the Ernst & Young Entrepreneur of the Year Award in financial services, and this puts us in very good company. This is a very prestigious award. Companies like Apple, eBay, Microsoft, and Starbucks all received this particular award. So we're very proud of the product. We're very proud of what it's been doing for families since 2005, 2006. We never stopped. We continued to improve the program, and now our systems are completely automated. And back in the day, our systems were all manual and all paper. We didn't have much presentation material, but we have everything automated today. Common sense thinking, insanity, the definition of insanity, there's a lot of conversation about who actually coined this, but I did find it under Albert Einstein. Definition of insanity is doing the same thing over and over again and expecting different results. But if we want to solve the problems that we have created in our lives, whatever those problems look like, we can't solve the problems by using the same kind of thinking we used when we created them. We need new thinking. We need new technology. We need to adapt and overcome and find solutions. The basic principles of banking that we're going to be looking at this evening and that are involved in the Worth Account program are closed-end loans, amortization, interest cancellation, open-end credit lines, float and leverage, and the concept of offset accounts, which we will coin that as an ALOC. ALOC stands for Advanced Line of Credit. There's 3 basic components that we're going to discuss this evening as the driving force behind the Worth Account program. The first is your first mortgage. The second is an advanced line of credit or an ALOC, and the third is the Worth Account program and coaching system. So let's jump right in. Your first component is your first mortgage, and your first mortgage is set up as a closed-end loan. A closed-end loan requires a minimum of full scheduled payment, allows payment in but no withdrawals. It's driven by an amortization schedule, calculates interest charges from the month-end principal balance. What we know about this type of loan is that it is very locked. It is very inflexible. Really, the only way to beat this kind of loan is to power money towards principal, and we're going to find out that there is another solution. To give you a look at this loan, if we have a $200,000 mortgage, 6% interest, the monthly payment would be $1,199.10, and that would be based on a 360-month amortization or 30-year loan. And our total payback of that loan is $431,677. Now, I don't know about you all, but I borrowed $200,000. That means I'm going to pay back $231,677. And we should all be disgusted by that number, that we are actually going to pay back more money than what we borrowed in principal. Let's take another look at this on the amortization. On that particular loan, if I make my first payment on that loan, $199.10 goes to principal and $1,000 goes to interest. What that basically means is on that first payment, I am paying 83% interest on that particular loan. Now, you know, when we do a mortgage, they say it's 5%, 6%, and with new disclosures in mortgage, they have to actually calculate what the long-running interest rate will be with all of the interest that will accumulate over that 20, 25, 30-year period, whatever kind of mortgage you have. If we move into month 2, what we see is that our principal contribution only increases by $1. We go to $200.10 in principal and $999 in interest. After 1 year, I want you to start looking in the equity and paid position. We've paid in $14,389, but our equity position is only $2,456. That's after paying on that loan for 1 year. After year 5, we paid in $71,946. That means our equity position is only $13,891. In that particular interest, in a 5-year period on this mortgage, we have paid $58,055 in interest, and this is the time frame that a lot of people refinance their existing mortgage. Well, if you do that and take it back to 30 years, you're tacking that $58,055 right back into your loan, plus your closing costs and fees. And what I really want to do this evening is educate you on how all of these different aspects come together to make the Worth Account program as powerful as it is today. Year 10, we paid in $143,892, and our equity position is only $32,628. And here's the one that really gets me. After 21 years of paying, I've paid in $302,173 in total payments. My equity position is only $100,122. I still owe $99,878. I still owe almost 1/2 of my original principal balance. And let's remember, this is a total payback of $431,677. There has to be a better way. So let me show you the traditional prepayment example. If I make my first payment of $1,199.10, I'm up to date with my loan, I can apply any additional money to principal that I want. So let's say that I want to make my payment and apply $5,000 to principal, direct the lender to apply that to principal. That means I'm going to make that first payment in the amount of $6,199. If I do that, moving into month 2, I no longer have a $200,000 balance. My balance is now $195,000 less the $199.10 for my first payment, but I don't think you'll all hold that against us. We're trying to go with the worst case scenario. So starting in month 2 with a balance of $195,000, 6% interest, a monthly payment of $1,199.10, I would only have 337 months remaining instead of 359. My original interest I should pay back is $231,677. Now I'm only going to pay back $208,373. That's a net savings of $23,304. So I guess this begs the question, would you make a $5,000 investment for a $23,000 return? Now, I've heard all of the philosophies. I want my tax write-off. I can get a better recovery and investment rate if I go to the stock market. But the reality is this. In all of those areas, you have an element of risk. In this particular scenario, the risk is the fact that you have 30 years to pay back and $431,677. If you can reduce that debt load by 23 months and $23,000, I believe that would be a win-win for everybody. If you're that worried about the tax write-off, pay your mortgage off in 9 to 10 years and go buy another property. Conventional banking wisdom versus the Worth account. Conventional banking wisdom says the only way that we can pay this down is refinance to a lower interest rate or apply more money to principal. With the Worth account program, there's no refinancing of your first mortgage necessary, and there is little to no alteration to your current standard of living. And I know all of this sounds hard to believe for people that may be listening to this for the first time, but remember, we've been doing this since mid-2005. We are with the BBB. We have an A+ rating, and we have over 70,000 satisfied clients with this program. So let's talk about component number 2, and that was the advanced line of credit. We're going to show you how this comes together to create a vehicle to help pay this loan down in an incredibly accelerated fashion. So with the advanced line of credit, what I want you to understand about advanced line of credit is this is called an open-end loan. Money will be applied to the loan balance when it's received. It's the ability to adjust principal balance multiple times per month, and it views the daily balance to assess interest charge. What we see with this type of loan, it's a lot more flexible. We have a lot more ability to manipulate this type of loan than we do with that closed-end loan. We can actually make partial payments throughout the course of the month on this type of loan, and we cannot do that on a closed-end loan. This type of loan typically offers an interest-only payment or a minimum payment option as well, and we're going to see that's going to be a benefit to paying down your primary mortgage. I think the first thing I would ask anyone before listening to this presentation, did you ever think about using a line of credit to pay off a primary mortgage? And my experience in this industry tells me that most people will say no to that question, but let's enlighten you and let's open up that door so you can see this. For ALOC functionality, it functions as a primary checking account. It receives all of your monthly income, so you're going to put your paychecks into this. It provides the ability to pay bills out of an ALOC. For optimal performance of your ALOC, you want to deposit the maximum amount of money into the ALOC per month, keep it there as long as possible, and spend the least amount of money by the end of the month each month. So let's look at a typical financial example. We're going to call this our model monthly budget. If we make $5,000 a month in net income, and you notice I am highlighting net because you cannot spend your gross. So we want to focus on net income. Let's say you have $4,000 in living expenses. That would be your total in living expenses, gas, groceries, your mortgage payment, insurances, anything and everything you spend your money on, leaving you with a $1,000 discretionary income. Now on this component number 2, the ALOC, whether it's a $30,000 line of credit available, with a $60,000 line of credit available, or a $200,000 line of credit available, the client would pay off their first mortgage in the same amount of time. So the breadth and width of the ALOC is not the deciding factor to how quick an individual can pay off their primary mortgage. And what we are finding is the availability of ALOCs on the market today is absolutely on the rise. I actually received a letter from Bank of America offering me a CLTV, combined loan to value, with my current mortgage of 105% to take out an ALOC with Bank of America. You can find a lot at 70%, 80%, and 90%. These are now coming back on the market now that the mortgage market has stabilized and we have the new regulations in place for security for the homeowner and the borrower. So let's take a look at month 1 on the Worth Account program. The maximum fee for the Worth Account is $3,500, and we're going to say that we pay that fee to purchase the Worth Account program directly out of our ALOC. So we have a $3,500 balance starting off on our ALOC. Remember, we're going to use the ALOC like a primary checking account, and we have $4,000 of living expenses. So we're going to pay all of our living expenses using that ALOC. At the end of month 1, we're going to have a balance of $7,500, okay? Now watch how this comes together with interest cancellation. With the $7,500 average daily balance owed, I'm going to give it or make a payment of $5,000 to my home equity line of credit with my paycheck. Now, a lot of you are saying, well, how do I pay my bills? Well, remember, you have the ability to pay bills out of your ALOC, so you could take money back out and put money in. That's going to give me a new average balance of $2,500. The bank can only charge me interest on $2,500, and if I was at a 10% ALOC, now I want you to hear that, if I was at a 10% ALOC, which is ridiculous. ALOCs now are going between prime plus 1, maybe prime plus 2, depending on how far you go with your CLTV. But the bank is looking for $20.83. So look at how this came together. The starting balance was $3,500. The ending balance or average daily balance is $2,500 because of my discretionary income. The lender was looking for $20.83 in finance charge. You as a consumer never made a monthly payment of of $20.83. Your income covered the monthly payment. The new average daily balance with finance charge is $2,520.83. The reality is you made a payment to the ALOC of $5,000. That more than covered the $20.83. So what does that mean? That $20.83 was charged in interest out of that $5,000. The rest of that was applied directly to the principal balance. Let's look at component number 2 on the ALOC, and this is in this component number 2, we had a $7,500 balance borrowed from the ALOC. The interest assessable balance was $2,500. You paid no interest on the $4,000 you used to pay your living expenses. You paid no interest. Your ALOC became the interest cancellation account. So let's look at how this money flow comes together. This is potentially tax deductible, but please consult your tax advisor before making that decision. I am not a tax consultant. If we look at the cash flow for the Worth Account ALOC, what we see is that we get our paycheck, we put it into checking, we transfer that over to the balance on our ALOC, and that reduces the balance on the ALOC. We get another paycheck, it floats through our checking account, and then we place that money on top of the ALOC. Now what has happened is we've paid down that balance on the ALOC, like we saw in the example, down to $2,500. And at this point, the program initiates what we call a funds transfer. Now, the funds transfer is the teeth of the Worth Account program. This strategically informs the client where is the best place to apply money from the ALOC and the exact dollar amount that needs to be applied to the ALOC in order to get the best performance. It generates the funds transfers. It looks at all of our debts individually and systematically and determines which debt is the best debt to pay that money to. Very simple process. It is all done behind the scenes for the consumer. I'm going to show some screenshots here. It is all very automated and all very simplistic to follow and very easy to update. So let's look at a closed-end loan versus an open-end loan. The closed-end loan, eliminate interest, control your money so money doesn't control you, get your money working for you. The open-end loan, income forces adjustment to the principal balance, and it creates the interest cancellation account. So let's go for a moment to component number 3, and that would be the Worth Account program and educational system, and then we're going to come back to a second month in the ALOC presentation. The Worth Account provides you with a financial dashboard. It's an expense planner. It's an online account register. It maximizes your money performance. Takes between 10 to 15 minutes per month to update the program. The Worth Account program does not move money. The Worth Account program does not pay bills. You are still in control of your banking. No need to change your current banking situation. It's extremely user-friendly. It's simple to update. It provides you with a tracking tool. It functions also as an account register and manager. It wants to know how much money is coming in and how much money is going out. It tracks your monthly budget and includes continuous customer support, coaching, and education. One of the things that I am the most impressed with about this program is we have clients that are actually retirees that are not very computer savvy, and we have gone as far as to actually help people make contact with people like Best Buy or Fry's to purchase a computer, show them how to set it up, and then take them through the process of utilizing the program. Do not let your fear of technology or your fear of a computer stand in the way of you saving potentially hundreds of thousands of dollars on your primary mortgage and other debts. I do want to highlight here that the Worth Account is not just set to eliminate mortgage debt. It can be used for student loans, car loans, credit card debt, tax liens, whatever it is you have in your debt portfolio at this current moment, the Worth Account can eliminate it. And let's make no mistake, if you have debt, you are in bondage. If you have debt, you are in slavery to that debt. And isn't it amazing that debt is usually placed on things that we already own? Here's your first look at the Worth Account program. At the very top, we have the dashboard, and a lot of people call this the motivator. And what this shows you is 9.3 years to pay off all of your debt that is listed on this program, that you would only pay back $68,459 in total interest. That means you have a potential interest saving of $171,911. Now, we do a free analysis for our clients, and we do a reveal for you that shows you your current situation and shows you what you stand to gain by incorporating the Worth account into your current financial position. So I just want to ask you a question. If those were your numbers and you had a 27, 28, 29, 30-year mortgage still remaining, and somebody came to you and said, we will give you a guarantee on this product that you'll pay off in 9.3 years, you'll only pay back $68,000, and you have the potential to save $171,000, wouldn't you go from disgust at that number, $431,677, to pay back to complete adulation and joy and hope at the fact that you would only have to pay back $68,459 of that interest, and you could save over $171,000 in future interest? This is what we see for our clients. And remember, again, our average client 1 year after getting on the program is typically about 20% ahead of the numbers that we originally gave them on the analysis. If we move into the next screen, this section in the body is called your action plan. We like to call this your to-do list. This section is your prompts and reminders of when paychecks are coming in, when bills are due, and when funds transfers are initiated by the program. This is very easy to follow, very user-friendly. If we move over, this section is populated by populating your budget and your accounts. If we look at the budget screen, we have the ability here to load our income, our food, our dining. We could do broad categories like food and dining, or we can break these categories down into subcategories like I did with bills and utilities. Now, if you're a very detailed person, you may want to break it all the way down into very minute, detailed, budgeted items, or if you're more of a round picture thinker, you may just want to go with food and dining, bills and utilities, insurance, and build broad categories. Inside the program, you have the ability to add income, add expense, and add transfer, and it's just as simple as clicking on one of these icons and then filling out the necessary information. When we go to our account section, you can see this is where our checking, our savings, in this case, the individual has an auto loan, a Visa, a first mortgage, and a home equity line of credit. And I want you to look at the balances there. This individual has $235,500 worth of total debt, and it's still telling them that they will pay off in 9.3 years. Remember, their income, if we look at it right here, their total income is, as we saw on the previous page, is $5,000 with $4,000 of living expense. And as you can see, they don't have a heavy savings account or a broad portfolio outside of what's loaded to the program. In the account section, we add a new account. We do this by going, you can actually add your accounts online. You can click online, search for the account, put in your username and password, and it will actually download your transactions directly to the program. We also have a function inside the program that you can get automatic download of transactions in the future. That does carry a very small monthly fee, but that takes you off of manual operation with the program and allows you, every time you use your credit card or every time you use your debit card for any transaction, it will download that information directly to the program and then place that information into the mix in the matrix. And typically what that will do is change your dashboard so the program is operating with you in real time. If I could describe this program alongside anything, I would put it in the same ballpark as like a navigational GPS system that we have in our automobile. And there's two things I want you to understand about a navigational system. In the beginning, when you put in the location that you want to travel to, it is leading you. It is giving you the directions of how to arrive at your destination from point A to point B the quickest and most efficient way possible. But many times we know that when we're on a trip, on a journey, when we're traveling, we will make detours. We will make sidetracks. Sometimes these are unforeseen because of things that crop up in the road, and sometimes it's because we see a sign and we want to pull off the road, or maybe we were just talking or rocking out to a song and we lost track of where we were and we missed the exit. But here's what I want you to get out of that. Once that occurs, a navigational GPS now begins to follow you. It begins to give you course correction, telling you to make a U-turn or take the next exit and turn around, or you have to travel 5 miles up the road. But it is now following you. It's not leading you. And the reason that I liken the Worth Account program to a navigational GPS is the Worth Account program will speed up, accelerate debt pay down if you're doing really good on your budget. Maybe you earn a little bit more money. You are in a better financial position than when you first set it up. It will start to accelerate. It will lead you. But in the same context, if you have a bad month, if you get a little bit overwhelmed with bills, if you make a little bit less money, if you, in fact, make a detour in your financial journey, then the program will begin to follow you, not keep you to the same regiment, because it understands exactly how much money you have available that is not earmarked to be divided towards debt elimination. So the program can lead you and follow you, whether you're in very positive situations in your finance or you're beginning to struggle a little bit in your finance. The program also offers you the ability to look at all of your accounts and your budget at one view in one location. So there's no longer the need to go to multiple websites to check your balances. There's no longer a need to go to multiple websites to see where you are in any given period in time. If you are directly connected to your lenders with downloadable transactions, your accounts overview will automatically update, and your budget overview, as you execute actions in the program, it will update and show you how much money you still have remaining in certain budgeted items, how much money you've already spent, and gives you this dashboard in real time. So this, make no mistake, this is the only program on the market today that is interactive with you in real time. We also have a very robust report section inside this program that allows you to run reports on budget, net worth, your time frame. You can search transactions in order to find out what is going on with your current financial situation. You can also use this to run reports at the end of the year. I do not suggest this as a replacement for QuickBooks or for Microsoft Money if that's what you're using with your tax guide, but it is a phenomenal backup record of what you've spent your money on and what your financial picture has looked like. What we're going to talk about right now is the funds transfers, and we can see right here on 12/1/2014, we see that it's telling us to take money out of our savings, pay it to our HELOC, home equity line of credit, which is what we call an ALOC, and in the amount of $1,023.64. And these funds transfers are always designated by these two red arrows. This means transfer funds. Now remember, you can't move money inside the program, so you would use your normal banking systems to make a payment from your savings account to your home equity line, your ALOC, in the amount of $1,023.64. Make no mistake, this $1,023.64 is not a roundabout number. This program is tracking 24 hours a day, the money coming in, the money going out, and the intervals that money comes in and the money goes out for bills and budgeted items. This is to the penny the money you have available at that point in time to pay towards debt reduction. That's how we can say that we can eliminate your debt in a fraction of the time, destroy your debt without altering your current standard of living. One of my favorite features in this program is a feature called True Cost. And in the true cost scenario, not only will it show you the true cost of your spending, but you can go in and add a new action to this program, which we can see right here, add new action. And you can actually ask the program a scenario, like if I was to buy an $8,000 ATV and I was going to use my my ALOC, or I was going to use my Visa, or I was going to take that money out of savings, what the impact would be of that $8,000 purchase. And just to give you an idea, I'm showing you just a true cost here on your power bill, not an added transaction. But if you pay a $200 power bill in this particular scenario, that is actually costing you $276.50. That means because of your current debt load, because you are not putting that money towards debt elimination, that when you pay that $200 power bill, you're actually paying $76.50 of additional interest. I did a scenario, and I will be doing a demonstration of this product next Monday. And on the demonstration, I'll take you through a real-life example of true cost, and I do an $8,000 ATV. Now, the mind-blowing thing about that is you're doing an $8,000 ATV, but the true cost in this scenario is $18,700 and change. So that means by removing $8,000 to buy that ATV while you're in this position in debt, you're actually paying an additional $10,700 in interest because you have prolonged the payments to your other debt by incorporating a new $8,000 debt. And what we find out is that this particular feature really gives people a bird's eye view of how their money operates and how money truly operates. And then you can ask yourself the question, do I really need that $8,000 ATV at this moment in time, or is it more to my advantage to get out of debt? So I want you to understand the advanced line of credit. It is not a savings account. Positive money does not accumulate. This is a line of credit. The balance can never drop below zero until you finally pay it off, then it will be zero. But you can't store up money here and you can't pay it to a negative balance. It's one of the vehicles that drives the Worth Account program. What we talk about here is interest float, or using other people's money in order to pay down your debt. That is what the truly wealthy do. I'm not talking about the rich. That is what the truly wealthy do. Okay, so let's look at month 2. Remember, we had a start balance moving into month 2 of $2,500. It was actually $2,520.83, but we're going to call it $2,500. Now, we're going to say that the program gave us a $5,000 funds transfer. So we're going to take that money from the line of credit and pay it to our first mortgage. Remember, we have $4,000 in living expenses. So our average daily balance is $11,500. Interest cancellation, let's look at this through this process, and we're only in month 2. We have an $11,500 balance. We give it a $5,000 paycheck. Our new balance is $6,500. The bank can only charge you interest on that $6,500, which is $54.17. Remember, I'm using a 10% home equity line of credit to pay down a 6% mortgage. Doesn't that sound absolutely insane? Where in the world would you use 10% money to pay off 6% money? And I want to make the point. It's not the interest rate that matters when you come to the Worth Account program. It's the banking instruments that you're using. It's placing the open-end line of credit against the primary mortgage, which is closed in. It is leveraging the bank's money from the home equity line of credit, what we call an ALOC, against the bank's primary mortgage, that closed-in mortgage loan. This is a phenomenal process. If you research it online, this concept has been around for a long time, and so many people say that it's easy to operate online. I want to tell you that this can get out of control if you try to do it on your own. We have had clients contact us, say they researched it online, they tried it, their ALOC went out of control, they started paying too much interest, they lost some income. The beauty of the Worth Account program is it is your watchdog for the ALOC. It balances and tracks the amount of money that's in there, how much interest you're paying on that ALOC versus how much interest you're saving on that primary mortgage. And the beauty of that is that the program will always set you in the position that you have a net benefit to using the ALOC to pay down your mortgage rather than the amount of money you're paying on the ALOC versus the amount of interest that you would have to pay on that primary mortgage. This is a proven system, but we are the only company on the market that offers a management tool for operating this system. There are a lot of copycats out there, so don't be fooled. We are the originators of this program. We are the originators of the concept, and we are absolutely the Cadillac in this industry. So let's review. We had a $2,500 start balance. We ended up with an average daily balance of $11,500. We gave it a $5,000 paycheck, which gave us a new average daily balance of $6,500. The lender was looking for a payment of $54.17. We never made a monthly payment of $54.17. Our income covered that payment plus. The new average daily balance with finance charge is $6,554.17. They made a payment to the ALOC. We made a payment of $5,000. That more than covered the minimum payment of $54.17. So the remainder of that money is applied directly to principal. And you can see how this would go in month 3, month 4. Every single month it does not give you a funds transfer. Remember, it tracks with you. It follows what you are doing. If you're doing well, it'll speed up. If you're not doing so well, your funds transfers will become smaller and they will become less frequent. But at the end of the day, there will always be a net benefit for you. $11,500 borrowed from the ALOC. They can only assess interest on $6,500. That means we paid no interest on the $5,000 that we used to buy down the principal on our primary mortgage. What they did was traded $23,304 of scheduled closed-end interest charges for an open-end finance charge of $54.17. So I beg another question. Would you pay $54.17 to save $23,304? But let's look at this another way. Let's say it took me 6 months to pay down the line of credit at $54.17 of interest. So if I take $54.17 and multiply that by 6, that means I paid $325 on the ALOC and I saved $23,304. Raise of hands out there, how many of you would spend $325 to save $23,304? Okay, let's say it didn't take 6 months. Let's say it took a year. Let's multiply that by 2. It takes me a year to pay back the ALOC at $6,500. So let's multiply by that by 2. How many of you out there would spend $650 to save $23,304? All right, let's just be ridiculous. Let's say it takes you 5 years to pay back the home equity line of credit, whatever that example is. But remember, the program is going to concentrate on paying that line of credit down as fast as possible. So let's multiply 650 times 5. How many of you out there would pay $3,250 to save $23,304? It's an absolute no-brainer. When we refinance our primary mortgages, we have more than $3,000 in closing costs. Let's get out of the dark ages. Let's get out of pencil and paper. Let's get off of the spreadsheets. Let's get off of the conventional wisdom that the banks have been telling us and programming us for so many years. And let's get up to 2017 with today's technology, automated technology, that can absolutely eradicate and eliminate debt. This is the power of the Worth Account program. This is reality, people. If you are on this call, you should be excited about the information that you're seeing. You should want to share this information with every single person you know. You know, there is a problem in America today, and that problem is uncontrolled debt. I'm not saying that managed debt is a bad thing. That's how we function in this world. But uncontrolled and unmanaged debt is putting people into slavery every single day of their lives. The amount of bankruptcies per year are just appalling. So let me give you a comparison of a rundown of a $200,000 mortgage. Your balance in 1 year with an offset program would be $184,811 in this particular comparison. On a conventional program, your balance in 1 year would be $197,543. Which side do you like better? In order to get a balance of $184,752, you would have to pay your conventional payments on a conventional mortgage for 5.5 years. With the Worth Account program, we will pay this loan off in 9.3 years. We will only pay back $68,460. On your conventional program, it would take you 30 years. You would pay back $231,677. That is a total interest savings of $163,217. I just need to ask, if that was your situation, wouldn't you be just coming out of your skin? Wouldn't you be absolutely enthralled and excited about the possibilities of being debt-free in 9.3 years? I do want to let you know that some of the driving accounts with the Worth Account are a home equity line of credit. We call them all of these an ALOC, a personal line of credit, commercial line of credit, secured line of credit. Even some credit cards and PayPal can operate as ALOCs for this account. But I want to let you know something. Since the mortgage crash in 2008, we retooled the program. We made this so anybody and everybody can get on this program. And I want you to think about this. If you can pay your debt down in an accelerated fashion, don't you think that would improve your credit score? If you can improve your credit score and improve your equity position, that can, in a very short period of time, put you in a position to be able to acquire an ALOC that you can use as one of the driving factors in the program. But we realize not all people have equity. Not all people can qualify for an ALOC. So you can use the Worth Account program with just a simple checking and savings account to start off your journey to financial freedom, learn the concepts, have technology behind you, have coaching and support behind you to lead you as a financial navigational GPS on your way to I am debt-free avenue, to I'm not paying the bank all that interest lane, to I am building my future and I am going to leave a legacy of wealth and not a legacy of debt. This is Max Saunders with Worth Unlimited. I want to thank you so much for joining me for this presentation. Get in touch with everybody you know. Have them view this. It is time to buy America back, one family at a time. I want to thank you for joining me.